Hello, fellow Rebel Capitals. Hope you're well. I was not planning on doing a video on the dollar today, but I looked at a chart of the DXY and I almost fell out of my chair. I don't know if I've ever seen a move like this in the dollar index. So I wanted to go over this and kind of think it through in real time with you guys right now. So let's get over to the DXY. Let me do a screen share. And I want to show you guys what's going on here and then try to just figure out what on earth. I mean, we got corporate credit spreads blowing out. We've got the Trump admitted that he dropped the tariffs due to the bond market, by the way, if you watched my last video. But anyway, let's get into the DXY. That's what. Okay, so it's up. It ticked up when I saw this. It was down 2% for the day. Now, you guys might say, "Oh, 2%. That's like a move in the S&P 5. That's like a 5-minute move in the S&P 500." Yeah, but this we're talking about the DXY. We're talking about the dollar. This is a whole different ballgame. In fact, I tried to use stupid Chat GPT over there on my other computer, and because I tried to figure out what the biggest daily declines in the DXY have been on record, and I can't really find that. It's like the $20 a month version too. Stupid Chat GPT. Josh, you've got like the $200 version. Try to get Chat GPT, the artificial intelligence, to actually give us an intelligent answer and tell us when like the top 10 biggest declines in the DXYs. Why don't you try to pull that up while we're talking here and while we're trying to think this through? I mean, I know that I saw a Coinbase article where they were talking about the biggest weekly decline, but of course they didn't mention. They said this is one of the biggest weekly declines we've ever seen in the dollar by Bitcoin, and of course they didn't mention what the decline actually was.
I have it up right now.
Okay, yeah, let me pull it up there. Let me take a look at it.
So the 5 biggest stocks drops were Black Monday, 22%.
Pull it up. Can you pull it up on your screen, Josh?
Can you not see it? Oh. I forgot that you were sharing your screen.
There you go. Okay. So no. That's the stock market.
What were you looking for? The dollar?
The DXY.
Oh, I misunderstood. Let me see.
No, the dollar. I'm looking for the DXY. So here, let's go back to. Okay, that makes sense. The Plaza Accord. So how much did it go down there?
4.3%.
Okay. Holy
2009,
cow.
3%. So we're in the top 5 right now, or we've got to be.
No, well, when I looked at it, we were down 2%.
Okay, so maybe we're number 6 right now.
Okay, so thank you very much. And just keep that pulled up just in case we want to go back to it as a reference point, Josh. But let's get back to, okay, so now it's bouncing. Now it's bouncing. But this is what I was talking about, guys, right here. And it just, we start dropping and dropping and dropping and dropping. And I think I put collapse in the title of this video. I'm not using hyperbole. I think that is historically accurate based on what Josh pulled up. Josh, what was the Plaza Accord day? What was that? September 22, 19, what would it be, 85?
That was 85.
What was the percentage drop?
4.3%.
Okay, that puts things into context. So during the Plaza Accord, and if you guys don't know what the Plaza Accord was, that was when the United States got together with Japan and Germany and a couple others, and the dollar was so high that they determined that it was better for everybody to artificially drop the value of the dollar. So this is Japan, Germany, and all these other countries basically dumping dollars as fast as they can. And I believe the Federal Reserve, I don't know how they would have done that mechanically, but this is global governments collectively together in unison trying to drop the value of the dollar. And the biggest daily move they could get was 4.7. And right now, we were, just before I went live, we were at a drop of 2%. Now, I'm just watching this in real time. We're still at a drop of 1.82, and we're midway through the day. I mean, I would assume this is going to bounce. I mean, that would probably be my base case, that this is just, I don't know what this is, to be honest with you. I mean, I'll continue to try to think it through as we're here on the live stream. But this is a huge, especially intraday move. And we're not talking about the daily move. We're talking about it's down, I mean, almost 2% in the last few hours. So who knows where I mean, do we end at 100? Maybe. I mean, do we go to down 3% in one day? I mean, which takes us close to the Plaza Accord of 1985. I don't know. You can see it's bouncing right now. Just to be clear, without a lot of information, I would, my base case is that we bounce back up, into the 102 range, and that this was just a result of someone completely and totally dumping dollars. But I don't even know. See, here's what's normally you'd say, well, duh, George, of course they're dumping dollars. They don't want to deal with the United States and blah, 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 blah. Now this is the beginning of hyperinflation and yada, yada, yada. But that argument really doesn't hold a lot of weight when you look at all the data. So what I'm referring to is the Treasury market. So we've got the Treasury market where bond prices have been skyrocketing. This would tell you that there's a dollar shortage, right? That there's people don't have dollar credit they need. That's another way of saying it. People don't have dollar liquidity, and they have to have dollars. You see, so they're selling whatever asset they can to try to get those dollars that they need to go ahead and pay down debt or whatever it is. And so that might not necessarily make the dollar skyrocket. That's when you're going to a safe haven. But this flies in the face of what we are seeing in the Treasury market. So if the Treasury market was being bid and the dollar is going down, that would make, I guess, a little bit more sense. What would make the most sense to me is if the dollar was going up and the Treasury market was selling off due to liquidity. So it all depends on what the underlying factors are, right? Because if the yields are going up for a different reason, well, then that's a completely, you would come to a much different analysis, or the analysis would lead to a different conclusion. That's what I'm trying to say. So this is the only thing I know right now is this was not on my bingo card. I'll be the first person to admit this was not on George Gammon's bingo card. I guess what we can say is there's just so much volatility right now. There's so much uncertainty. There's so much insanity that, I mean, this is just, again, Trump has basically, and to be fair, this isn't all about Trump. I think we would have probably seen something like this as far as an economic contraction or recession, even without tariffs. I mean, this was, I look at the curves, look at everything we've been talking about on this channel. The fundamentals of the economy were weak and they were deteriorating very, very quickly. But then you're just adding fuel to the fire right here and taking that snow globe like we talked about yesterday and just shaking it up. And you don't know what the knock-on effects are going to be. And this is a great example right here. I'm going to be very surprised if even over the next week we go over, or excuse me, we go under 100. I would be very surprised, but it's possible. I mean, who knows? Again, take it for what it's worth, guys, because if you would have told me that based on everything else that's happening, the dollar would be down 2% today in the matter of just a few hours, I would have said no. That's extremely low probability. Let's go over to corporate credit spreads. Maybe this is giving us some insights. Then I want to go over to the Treasury market itself to see how that could be potentially changing. I know the 2-year was down massively. So let's actually check that out first. 2-year down almost 12 basis points today. And what's interesting is, that's kind of following the chart that we saw of the DXY. Another thing to think about is the fact the DXY is 57% euro. So is this dollar? In fact, let's check that out, guys. That's actually a really good point. So we're going to come back to the 2-year, 10-year, 30-year. But while I'm thinking about it here, let's go back to, the stock market's crashing today. NASDAQ down 1,000 points. Keep in mind, it was up 1,800 points. So wouldn't that be insane if we lose all the gains from the Trump pump? The Trump tariff pump. I like Trump pump better. We lose all the gains from yesterday's Trump pump. But let's get over to FX. Oh, yeah. Oh, yeah. Okay. It could be all about dollar euro. I think it's all about dollar euro. Because look at dollar yen and look at dollar CAD. And even with dollar pound and Aussie dollar, you're not, you don't have that big of a move. The move is all in the euro right here. So let's try to look at a daily chart. Yeah, see, it's all euro. So now, okay, this is making a lot more sense. So since we can determine that this is pretty much euro specific, then we have to ask what happened today between the EU and the United States that would do this. And my guess is it's the EU coming out and announcing that they're putting a 90-day freeze. They're putting a 90-day freeze. So what happens here, guys, is let's just say U.S. tariffs, EU tariffs. We're tariff war, bam, bam, bam. We're in this pissing match where everyone's one-upping each other and whatnot. The market has to determine whose economy is going to be most negatively impacted. And whatever the market decides, let's just say it's Europe, then likely you're going to see that currency go down, all else being equal. Obviously, with FX, there's thousands of variables, but you're going to see the euro decline. So if the reason the euro declined to begin with, because this would most negatively impact the eurozone, if that is now taken off the table, then you don't have the pricing in the market for the deterioration of the eurozone economy that you had while the tariffs were in place, and therefore that's hugely bullish because for the euro itself, for their currency. So it's not that everyone's wildly bullish on the euro. It's just they're a lot less bearish than they were a couple days ago. I think that's the best way to frame this. And that's okay. Now let's go back to the DXY that I've had the chance to kind of think this through in real time. And we can see the bump that's corresponding with the euro over 101, which I think we were earlier. So I would be really surprised, even more surprised than I was saying earlier, if we get under 100. And I think over the next couple of days, this is going to go probably back up where it was. It's just like the stock market yesterday with the Trump pump. You get this knee-jerk reaction where it's just like, oh my gosh, buy, 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 buy. This just like temporary hysteria. And then overnight, everyone thinks about it and it's like, well, wait a minute here. Sure, he took off the tariffs, but did he decrease uncertainty or did he increase uncertainty even further? And there's a great argument that he actually increased uncertainty even further by just going back and forth and back and forth and back and forth. It's like a game of ping pong, not even like a game of tennis. That's like way too slow for Trump. This is like a game of ping pong, bam, 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 like this. And so, it's not like dropping tariffs isn't also shaking the snow globe. it's just maybe it's shaking it just in a different way or something like that. So I think yesterday the Trump pump was kind of a knee-jerk reaction, a temporary hysteria. Then we're like, wait a minute, does this really make sense? And then the market says no, sells off today. And again, take it for what it's worth, guys. This is just me thinking out loud. My guess is over the next couple of days, this goes back to maybe close to where it was, in the 102 range, because right now with the pause, the 90-day freeze in the EU tariffs, people are thinking, okay, thank goodness we're pumping the brakes on the trade war. And that means that the Eurozone economy is going to be damaged a lot less than we thought. At least the probabilities increase, and therefore we buy euro, we buy euro, we buy euro. But they're going to wake up tomorrow and they're going to be like, well, wait a minute here. Do we really think the European economy is going to do that well? Sure, you've got some defense spending in Germany for another war with Russia. I don't know that that's great for the economy. I don't know that I'd call that quote unquote stimulus. And then they're going to think about, well, wait a minute. Trump loves to shake the snow globe. And who's to say he's not going to just shake it tomorrow? And he wants to win. And the only way he wins is if other people lose. And this is, just kind of using that kind of mercantilist mindset that we were talking about in the last video. And then they're like, okay, and even if he doesn't, this has created massive amounts of uncertainty, which is going to negatively impact the European economy. And so that's probably how this plays out. But who knows? I mean, who knows? When you're dealing with this much insanity and just these daily Six Flag rides in the stock market and in the bond market, I mean, you're going to see stuff break. You're absolutely going to see stuff break if this continues. And I don't think this was a break like I thought right at the beginning of this video, because this makes a lot more sense. I think it's more sort of knee-jerk reaction. That's the bottom line here. So let's go over to the 2-year, because like I said, huge decline today, 12 basis points. Why this matters is because this is more of a predictor of what the Fed is going to do, because usually the Fed follows the 2-year. So if the 2-year continues to go down, then you just got to increase the probabilities that the Fed's going to be dropping rates, and that makes a lot of sense. Let's Josh, can you pull up my Twitter feed really quick?
Yep, I'm pulling it up.
What I want to do, guys, is we talked about this briefly in the last video, that it was my position. Trump was forced to the negotiating table, meaning that he was forced to, or he wasn't forced. I mean, he's not forced to do anything, but he was, let's just say, incentivized, highly incentivized to drop the tariffs because of the bond market was blowing up, and he didn't want to be the president that gets blamed for GFC 2.0. So a lot of people on the feed, especially when we were Rumble, were saying they had a different view. They had a view that this is all part of his plan, and that him dropping the tariffs on all countries except China, or dropping them down to 10%, let's say, was just more 5D chess and more Trump winning. And my position is no, that's not part of the plan. He's doing this because the bond market's blowing up and he doesn't want to create another financial crisis. And or because what didn't make sense to me, the reason I was coming to that conclusion is because if you're going into negotiation, or if you're not finished negotiating with a trade partner or anybody, you're not going to show them your hand. And you're definitely not going to let go of the leverage that you have. And the leverage that he had were the high tariffs. That's your leverage. So just because they come to the negotiating table doesn't mean that you just say, oh, I'm just going to release all of that leverage I had. I don't need that anymore. Of course not. You're not done negotiating. So then I want to, can you blow that up, Josh? Because this pertains to the 2-year Treasury yield. I'm going to connect the dots here in a moment. So we see President Donald Trump, and this just came out after I got done with the last video. President Donald Trump was aware the economy could enter a recession, but wanted to avoid a depression from his tariffs, according to a Wall Street Journal report. Now, Kevin Hassett, who is part of Trump's team here, director of the U.S. National Economic Council, told CNBC on Thursday that the collapsing bond market contributed to Trump's decision to walk back his trade policy. Exactly what I said. Exactly. Did I say that? Exactly. So who knows if I'm right about the dollar, but I got that one spot on. That is for sure. So let's just, all the talk of Trump playing 5D chess by dropping rates, or Ackman coming out. Can Ackman be more of a brown nose, for heaven's sakes? I mean, that guy rubs me the wrong way. Well, I don't know that I like Carl Icahn more than Bill Ackman. I don't know the guys, but I definitely like Icahn's approach more than I like Ackman's approach, for sure. But, Ackman comes out and says, this is a classic art of the deal. Trump, this is the plan the whole time. He just jacks up the rates. He throws in the grenade and then brings over to the negotiating table, then brings down, to a 10% level that's digestible by the entire global economy, blah, blah, blah. All part of the plan. Come on. Who are you trying to kid? I mean, you can love Donald Trump and just admit the fact that he had to, or he was highly incentivized to drop the tariffs on a lot of those countries because he didn't want to blow up the bond market and cause a GFC 2.0. I mean, I think that's actually a pretty damn good decision. I would favor not creating a GFC 2.0. I don't know why that's a bad thing. Anyway, so why am I bringing this up? I'm not bringing this up just to take a victory lap here. I'm bringing this up because if you're Jerome Powell right now, you see what's going on in the bond market. You absolutely unequivocally see what's going on in the bond market, and you see what's going on with the CPI. And if you guys didn't watch the last video, you got to check that out, because CPI month over month is negative, and it went from 2.8 down to 2.4. In other words, a decrease of 0.4%, and that's because of energy, but not energy in April, energy in March. And energy prices have been dropping way faster, at least oil. Now, I don't know, how much oil impacts the price of gasoline in real time, because I think that's their main metric there. But I would assume that it has more than, or it has more of an immediate effect than like a 3-month lag or something like that. So I would assume what happens to oil today impacts gas prices at the very least next week. Now, you guys that know more about commodities than I do can correct me on that if I'm wrong. But let's just assume for a moment we have energy prices going down to a greater degree in April than we had in March. And that was the big contributor of the decline from 2.8 to 2.4. Now we're getting to a point where we're very close to the Fed's target, if not below the Fed's target. So if, let's just assume for a moment, we're below Fed's target when we get the next CPI, and we've got the bond market basically freezing up, which Jerome Powell is no dummy. I mean, he knows that that is the no bueno zone. And even Trump's administration, I mean, Besant's a smart guy. You know, I might not agree with the things he says. I think a lot of what he says is strictly political. But he's a smart dude. And so he's, of course, telling Trump, which, I mean, Trump doesn't know anything about the bond market. He doesn't know anything about economics. Not that he's dumb, but it's just not his area of expertise. So, but fortunately, he's got some smart guys around him that are like, hey, Donald, yeah, forget the stock market. Forget the stock market. Stock market down 5,000 points? Nah, whatever. Hurt some guys on Wall Street. You can blame that on the fat cats, or you can just say that was all, that was all Wall Street. Now we're just focusing on Main Street. And if Wall Street has to pay a bit of a price, so be it. But when the bond market blows up, that doesn't just impact Wall Street. Just like the GFC didn't impact just Wall Street. So I think he probably got that tap on the shoulder yesterday morning. And that's what it was all about. And based on this CNBC report and based on what his own administration is saying, that's exactly what happened. So Jerome Powell is seeing that. Jerome Powell knows the risks to the downside if the bond market freeze, and that's a kind way of saying it. Jerome Powell knows exactly what happened in the GFC. And if he's got the cover of inflation going down, why on earth wouldn't he drop rates? Well, like he's got perfect cover. Assuming that we get down to 2% next month, why would he not drop rates? I can't think of an argument to keep rates where they are if you're Jerome Powell. So what does that mean for the long end of the curve? What does that mean for mortgages? Will they go down or will they go up because we get a bigger risk premium? I mean, these are all questions I think we should be asking right now. The main takeaways from this video, corporate credit spreads. They're blowing out, as you guys would imagine, but we've got to keep that in perspective. Here's where I tried to look up. Let's see. Let's look up corporate credit spreads. There we go. Now, honestly, guys, I'm not an expert in corporate credit spreads. I haven't researched this for like a whiteboard video. Usually when I do a whiteboard video on something, I understand. I mean, you have to, right? What I'm doing in most of those whiteboard videos, as you guys know, is I'm trying to explain something. And unless you know it really, really, really well, you can't explain it. And so, but I haven't really done a whiteboard video on credit spreads, so I haven't done that deep dive. Maybe I'll do that for the next whiteboard video. So I know this is a measurement of corporate credit spread. I just don't know what corporate bonds they're using for this. This is the ICE B of A US Corporate Index. So are they using all corporate or an average? Are they using AAA? Are they using junk, investment grade? You see, I don't know exactly what we're looking at here, but I do know, as you can see, that this measurement of corporate credit spreads, and I would say that pretty much all corporate credit spreads are blowing out right now. It's just to what degree. So I guess we can just use this as a proxy. So this is, so if we look at a 1-year chart, it's like, whoa, what just happened? This is a big deal. This is something we absolutely have to pay attention to. But to give some context, this isn't, we're not at the GFC levels yet. I mean, not even close. Not even close. So for that, let's just do a 10. I mean, you can see where we got during the cerveza sickness. I mean, there's times in here. So this was Russia, Ukraine, I'm assuming. That was corporate credit spreads blowing out. And then right here, we had Silicon Valley Bank, First Republic, and Signature, and Credit Suisse blow up. So that's when you saw those credit spreads widen as well. And then look, we saw the same thing in 2016 where it was much higher, much higher. But the point is this type of parabolic move, even though we're still only at 1.2, it's something we've got to consider. We don't want to ignore this, especially when you consider everything else that is going on right now. So I think main takeaways, if I can summarize, is we've got the decline in the dollar. From what I can tell, my base case would be it's a knee-jerk reaction based on the Eurozone putting a 90-day freeze on their retaliatory tariffs, if that's what we're calling them now, their reciprocal tariffs. And it's not just an unloading, or it's not a breaking of something. It's something in the financial system didn't break. Maybe it did, but I'm just telling you this is my base case on after what I've seen here on this video. So base case is this is all about Europe and not really so much about the dollar overall. More so about the Eurozone, more so about just a knee-jerk reaction with tariffs. My view is we're probably at 102 within the next couple of days. But we have still this massive volatility in the stock market. I wouldn't be surprised if we erase most of the Trump pump from yesterday. And what's still bizarre is bonds are high, although they're coming down, and they're coming down very, very quickly, which could lead you to the conclusion that the liquidity issue has temporarily been patched over in the monetary system, in the financial system, in the Eurodollar market. And if that's the case, then you should see yields really start to come down quickly. And then I think the other main takeaway here is that Trump absolutely 100% dropped those tariffs, not because of 5D chess or part of the plan, but because the bond market was blowing up and he didn't want to create a GFC 2.0. And good on him. Good on him. You know, he didn't want to create a depression, and that is going to make that's going to lead to the probabilities of the Fed cutting more aggressively than the market thought last week. That's going to significantly increase the probabilities, especially when you combine that with the CPI report today and what energy is doing. That's the summary for the video. On that bombshell, guys, enjoy the rest of your afternoon. As always, make sure you are standing up for freedom, liberty, free market capitalism. See you in the next video.